This is Perspectives, a bi-weekly investment podcast brought to you by Escala Partners. In a world cluttered with information, Perspectives cuts through the noise to bring you insights and commentary on global financial markets, economics, and geopolitical news and events.
Welcome to Escala Partners Investment Perspectives. I'm Ed Brooke, and today we're focusing this podcast on the United States. And it's easy to see why. There are so many significant policy changes occurring, including Liberation Day and the Big Beautiful Bill, which will have long-term ramifications. So to discuss where this is all leading is our CIO, Tracey McNaughton. Welcome, Tracey.
Hi, Ed.
So, Tracey, you presented at a conference last week. Let's start with the topic of your session. Have we seen peak US exceptionalism?
Yes, it was a very interesting topic and got a lot of interest from the delegates. So if we start by just first of all defining what we mean by exceptionalism, it's the idea that the US is somehow economically, structurally, morally better than the rest of the world. And, you could point to some evidence of this: a stronger military, bigger tech sector, deeper capital markets, and of course, the US dollar at the heart of the global financial system. Now, for decades, those pillars weren't just solid, they were unquestioned positions of truth. Investors didn't ask if they should be in the US, they asked how much. And so this is why so much of our superannuation is invested in the US. The typical international equity fund would have around 60 to 65% invested in US equities. But if you fast forward to today, it feels like something has shifted, or at least is in the process of shifting. Now, to be clear, Ed, the US hasn't become irrelevant overnight, and that's not what we're saying. It's still the world's largest economy and a central node of global finance. We know that 60% of foreign exchange reserves held by central banks around the world are in US dollars, and 80% of payments made globally are in US dollars. And in fact, many countries outside of the US accept US dollars as payment. That doesn't happen with many other currencies. There are some countries that accept euros, despite it not being their home currency, but they are very few. But the shine on the US, I think, as an investment destination has dulled. Investors are beginning to reassess, they're beginning to question. So the US feels like a little less exceptional. And you don't really need to look too far to understand why it has lost a little lustre. Political uncertainty, unpredictable policy swings, growing political interference in democratic institutions, a ballooning government debt. Capital doesn't care who's in office, or at least it hasn't historically. Politics, we've always said, has been in the background for investors. Capital just cares whether it can get in, make a return, and get out without political interference or unreasonable barriers. But I think that institutional trust is now being questioned, and we are considering now politics more when we're thinking about our investment decisions, which is something that's changed.
Tracey, just on the topic of ballooning government debt, the current fiscal proposal, the so-called Big Beautiful Budget Bill, it combines tax cuts with higher defence spending and no meaningful plan to reduce debt. It just ties in with investor concerns about fiscal recklessness.
Well, absolutely it does. That bill is very big. We're talking about a package that includes a continuation of massive tax cuts, ramped up defence spending, as you say, infrastructure outlays, and yet there is no meaningful effort to reduce the deficit. It's essentially an open tab on the US credit card, backed by the hope that investors just keep buying treasuries forever and fund the US government. Well, we've seen this movie before. In the UK in 2022, then Prime Minister Liz Truss tried to bring down a similarly reckless budget and was punished for it. Not only did she lose a job, but bond markets said that they're not having a bar of this and refused to fund the government. Bond yields surged as a result. The only thing preventing something similar happening in the US is this moniker of US exceptionalism. But as we've said, there are limits to how much profligacy investors will tolerate. The historian Niall Ferguson, who is just excellent, and I recommend any of his books, he put it simply. He said, the fatal arithmetic of imperial decline is when the interest on debt exceeds military spending. Well, guess what? The US is there. In 2025, it's spending over $1 trillion a year to service its debt. Its military spending is $900 billion. So the balance has flipped.
So, Tracey, let's look at what the market's telling us. US equities are basically flat for the year. Meanwhile, German equities are up 20%. And what about the tech titans, the so-called Magnificent Seven? Are they still magnificent?
Well, from a share price perspective, despite the recent rise in the market, the Magnificent Seven are all still below their 52-week high, some of them significantly so. I think this is a reflection of what the market has already priced in. Markets are forward-looking. They will look ahead to see what is coming down the track for these companies, what are their earnings expectations looking like, and then they'll price that in accordingly today. A great example here is in the market's reaction to NVIDIA's earnings result, which came out a couple of weeks ago now. It was the end of May. NVIDIA, who, is the poster child for the AI boom, just posted a staggering 69% increase in earnings in a single quarter. 69% increase in earnings. And what happened? Well, the stock price jumped 4.4% on the day. And the next day, it fell 4%. So that's not a reaction to weakness. That's a market saying, we've already priced in all the good news. And so there's a risk here that there's a little bit of fatigue setting in.
So if the US is losing its lustre, the next question is, who is looking more attractive? Is China a beneficiary of America's decline?
When we talk to our fund managers, and we do this every quarter, particularly those that invest heavily in China and the Asia region, they say the fact that the US is imposing such stringent restrictions on China, and in particular restricting the sale of chips, microchips to China, tells you just how worried the US is and how advanced China is becoming. It was interesting, we had a presentation at the conference from a US political advisor who was part of the team back in 2001, getting China its membership to the World Trade Organization. And he said something interesting. He said, if they had their time over again, they probably wouldn't have pushed for China to become a member so hard because they haven't got out of the relationship what they expected. So, in other words, China has evolved to the point of being a challenger to the US, a competitor, rather than simply a supplier to the US. And while I was in the US, I heard a lot about how China needs us more than we need them. And I think that was the case in the past, certainly, but I don't think it's so much the case now. China is the number one trading partner for 62 countries around the world. By comparison, the US is the number one trading partner for 31 countries. More than that, China has better trade optionality. It can redirect its exports faster than the US can redirect trust. So while the US, is alienating its allies, and it's hollowing out its education system, and it's abandoning global cooperation. China is doing the opposite. European leaders are flying to Beijing, not Washington. The US has walked away from more international frameworks in the past decade than in the 5 before it. So that leaves a vacuum that China is looking to fulfill. And it has the patience and long-term perspective to do it. It's often said the US thinks in days, China thinks in decades.
And so, Tracy, what does that mean for investors? Should we be increasing our allocation to China?
Well, Ed, on our dashboard, our asset allocation dashboard, which monitors 147 different data points, China is flashing as a buy again. Since Trump's Liberation Day tariffs on April 2nd, the US equity market has underperformed just about every major market. We're hearing a lot about how the US equity market has bounced back from its lows on that day, but it is still below where it was. Meanwhile, Europe and China are well up, which is ironic, isn't it? Rather than punishing them, the imposition of tariffs by the US has boosted the equity markets of its major trading partners. We're watching China very closely. It's still struggling with the collapse of its property bubble. We're also watching the rest of Asia, which will be a beneficiary of redirected supply chains.
So, Tracy, if we're in a world that is potentially going through structural change, where can investors find shelter?
Well, I think the first thing to say is the status quo is over, at least for now. This is a new world, one that is more volatile and one where past relationships may not be as reliable as they once were. And that's a really important point. One of those historically significant relationships was between the US dollar and US bond yields. Historically, they moved in the same direction. Higher bond yields means a higher US dollar. Why? Because higher yields attract capital. The model that investors and asset allocators have rely on that relationship. But that is now in question. Recently, we have seen the opposite. Bond yields have risen and the US dollar has fallen. And this tells you that, potentially, that investors are concerned with the financial standing of the US. The US dollar is no longer the automatic safe haven it once was. If your military edge is eroding, if your markets are slowing, if your debt is ballooning, how long can the dollar stay the world's safe haven? And coinciding with all of this, Moody's downgraded the US sovereign credit rating. That was significant. It's the first time in over a century now that the US lacks a top-tier rating from all 3 major credit rating agencies. And in making this move to downgrade the US, Moody's cited several reasons for the downgrade. They said they were concerned about rising debt levels, ballooning interest servicing costs, and political gridlock. So the fact that yields are rising without the US dollar tells you rising yields are no longer seen as a sign of economic strength. Instead, they're reflecting the fact that investors need to be paid more to accept a higher risk from investing in the US. So in other words, bond yields are going up because the US is becoming riskier, not more attractive. Where else are investors finding shelter? I would say cash. That's one of the places we've increased recently. Warren Buffett and others are doing this as well. The man who famously said, "Be fearful when others are greedy and greedy when others are fearful," has now accumulated the highest cash pile in the company's history.
So, Tracy, what if you still wanted to be invested? You mentioned China is looking interesting again. Where else?
India looks interesting for a number of reasons. The supply chain redesign will benefit India. They also have limited goods trade exposure. They're mainly a services-driven economy, so they're perceived to be less exposed to tariffs from the US. They've got a strong relative positioning in emerging markets, and they will also benefit from a weaker US dollar because of their US dollar denominated debt. We also like private markets as a haven away from the day-to-day volatility in public markets. Public markets are shrinking. We've talked about this in the past. There were 8,000 or so companies listed in the US market in the 1990s. That's down to 4,000 today. At the same time, private market universe is enormous and it's expanding. I'd also say a lot of the beneficiaries from the AI, the application phase of artificial intelligence, are coming from the private sector, the private companies. The other thing I would say is that managed fund design is changing. We talked earlier about the typical international equity fund having around 60 to 65% invested in the US. We are seeing more funds crossing our desk where the allocation to US equities is as low as 8%. I think what is happening now is a reminder that US exceptionalism isn't a birthright. Yes, US equities have been a star performer over the past few decades. We shouldn't forget, though, Japan beat the US in returns for the 3 decades prior to that.
And for decades, America sold the world exceptionalism, and the world bought it. But when debt costs more than defence, trust froze, and the dollar no longer commands loyalty. It's fair to ask, is the price of that belief now too high? Maybe we're entering a different phase, one where American dominance isn't automatic, but has to be re-earned. Thanks, Tracey. That's all we have time for today. I hope everyone enjoyed the update. We look forward to you joining us in a fortnight. In the meantime, please take care and stay safe. Thank you.
Thank you for listening to Escala Partners Perspectives podcast. Be sure to subscribe to this podcast on iTunes. You can connect with Tracey by visiting escalapartners.com.au. Escala Partners is a corporate authorised representative of Escala Wealth Management, which holds its own AFSL. This podcast has been prepared without consideration of specific client investment objectives, financial situation, or needs, and is for general information purposes only. Please don't rely on it for the purpose of making an investment decision. You should seek independent financial and taxation advice prior to making any investment decisions in relation to any of the content considered in the podcast, and consider any relevant disclosure documents. If you require any further information regarding the matters discussed on the podcast, please contact Escala Partners.